Core PCE, personal consumption expenditures, the Fed's preferred inflation gauge, logged its lowest annual increase since March of 2021 in January, while monthly prices rose at the fastest rate in a year. While there is still work to be done on curbing inflation, our next guest believes we are inching closer to the finish line. For more on the latest inflation read, let's bring in Tuan Nguyen, RSM U.S. economist. Tuan, good to talk to you today. How does this latest print fit in line with where you expect the economy to move?
So it's definitely good news that the year-over-year inflation numbers are going down, but a lot of people are focusing on the month-over-month and even the super core that show stronger print than last month. We're not too worried though about the strong inflation print in January because all the seasonal factors and also the spike in housing inflation, which if you look at it, is more like noise than trend. So I do think that, however, that given the rebound in energy and gasoline prices, we might see another strong number for inflation in February ahead of the Fed's March meeting. But even if that's the case, we don't expect any kind of sharp rebounds that really change the calculation for rate cuts in 2024. We think housing inflation will eventually come down in the summer and offset any kind of increases in goods inflation or energy inflation that everybody is concerned about. So if you look at the overall picture, we think that there are a lot of reasons to expect inflation to ease further in the summer.
So put the January numbers in context is what you're saying, just given the noise we usually see in that month. What does that mean in terms of when the Fed reaches that 2% target and when those interest rate cuts are likely to begin?
So in our estimate, we think that there's quite a good chance that we might actually get to 2% by mid-year for the overall inflation, PC inflation. And for the core PC inflation, we might settle around 2.5%, all because of that cool down in housing inflation. So that really continues to reaffirm our forecast that we made last December that we might expect a first rate cut around June this year. Now, if you look at what has happened in the past 3 months, we had some good inflation news, and the market kind of jumped ahead of itself to price in earlier rate cuts than June. Now, the probability of rate cut, the first rate cut in June is about 70% in total, which is not 100%. So that is why we always want to stay away from changing our minds with only a few data points, especially after looking at the January data. And we think that the Fed is in the same boat. They are not going to rush to cut rates too early. And by the summer, we think that the Fed will have about 1 year of inflation data that really supports lower interest rate.
So you say core PCE expected to remain around 2.5%. Then what is the incentive for the Fed to cut, even if it's just in June?
So I think around June, again, they're going to have 1 year of inflation data. And by that time, I think the economy will cool down materially. And if you look at the labor market, if you look at growth, I think there are a lot more incentive to the Fed to keep growth steady, to keep the labor market strong. And now with that in mind, though, I think it's very important to specify the risk that the economy might continue to outperform our expectations. And one reason is that if you look at the stock market, it has been on a massive rally since last year. And I think it is time that we cannot ignore the wealth effect of the stock market. We just put out research note this morning on the impact of the stock market wealth effect on total spending. And the rule of thumb is for every increase in stock market wealth, every $1 increase in stock market wealth, consumer spending increases by 32 cents. And if you look at all the gains from dividend and asset prices from last year, that could potentially account for 1 to 4% increase in total annual GDP on a nominal basis. So the bottom line is we don't think the Fed is in the position to rush cutting rates this year. So the risk is we might see 3 or even less than 3 cuts in 2024 if the economy continues to outperform.
So a rate cut in June or no rate cuts at all?
We think a rate cut in June, and then the Fed will have ample of time to think about the next rate cut after June, and they can even spread out the rate cuts like what they did with the rate increases that we saw last year. So just to slow down the pace of the rate increases. So this time they can slow down the pace of rate cuts, so they don't have to cut too much in 2024. Now, on top of that, we think that the Fed has the kind of luxury that they haven't had for quite some time. That is because of the increase in recent productivity might actually work well into the Fed's favor, that not only it will boost growth, but will keep inflation down at the same time. So I think, again, the Fed can really take its time to cut rates.
Tuan Nguyen, RSM U.S. economist, it's good to talk to you today. Appreciate the time.
Thank you.